Before you check your portfolio and tell yourself this is just another rough market day, stop. Because what's happening right now may be much bigger than a normal dip, and it may not be starting where most people think. The real pressure is building in Japan, and if that pressure turns into a full financial break, it will not stay in Japan. It can travel through bond markets, currencies, and global money flows straight into the United States. That means it can hit your stocks, your retirement account, your mortgage rate, your loan payments, and even the price of everyday life. This is not a distant headline for economists to argue about. This is the kind of financial shift that can quietly move from Tokyo to your wallet before most people even understand what's happening. So in the next few minutes, I'm going to break it down in simple terms, show you why Japan matters so much, and most importantly, what you need to watch now to protect your money before the real damage begins. To understand why this matters, you have to understand the role Japan has quietly played in the global financial system for years. Most people think of Japan as an aging economy with slow growth and its own local problems. But in money terms, Japan has been far more important than that. For a very long time, Japan kept interest rates extremely low. While other countries moved rates up and down, Japan stayed close to the floor. That created one of the cheapest sources of borrowing in the world. And cheap borrowing changes behavior everywhere. When money costs almost nothing, investors do not leave it sitting still. They borrow it, move it, and hunt for better returns somewhere else. That is exactly what happened. Japan became one of the quiet pillars of the easy money era. It helped feed demand for stocks, real estate, bonds, and risk assets around the world. So when people look back at years of rising prices and easy gains, they often focus on central banks in the West. But one of the hidden engines behind that whole environment was Japan. It was not standing on the sidelines, it was helping power the system. Now here is where the story changes. A system can look stable for years, right up until the moment it stops being stable. And that is what makes this dangerous. Japan's bond market has been under pressure, and that matters because bond markets are where the cost of money gets decided. For a long time, investors believed Japan could keep borrowing cheap, keep yields calm, and keep the whole structure from shaking. But when yields start moving higher, that confidence begins to crack. And in finance, once confidence cracks, the math changes fast. Debt becomes more expensive, leveraged positions become harder to hold. Assets that made sense under cheap money suddenly stop making sense. The same structure that looked strong under low rates starts to look fragile under higher ones. That is how a calm system turns unstable. It does not always explode in one dramatic moment. Sometimes it just starts bending in places people were not watching. And once that bending begins, everyone starts asking the same question at the same time. How fast do I need to get out? This is how the shock can move from Japan to the United States without ever feeling obvious at first. For years, investors used a simple strategy. They borrowed Japanese yen at very low cost, then took that money and put it into assets that offered higher returns somewhere else, especially in America. That could mean stocks, corporate debt, real estate, or other trades that looked more attractive than leaving money in Japan. In simple terms, Japanese money became fuel for global risk-taking. But when the pressure rises and that trade starts to unwind, the process goes into reverse. Money gets pulled back, positions get reduced, assets get sold. And once enough big players start doing that at the same time, selling stops being a choice and starts becoming a necessity. Then there's the second link, and this one matters even more for everyday Americans. Japan is also a major holder of U.S. Treasuries. Those treasuries sit underneath the entire American financial system. If Japan needs dollars quickly or needs to support its own currency, it can sell those bonds. And if a major holder starts selling into an already nervous market, yields can rise quickly. When yields rise, financial conditions tighten across the United States. Loans get more expensive, markets get more fragile, and suddenly a problem that seemed far away starts showing up much closer to home. The first place people usually feel that pressure is in the stock market, especially in big technology names. And this is where many investors get confused. They assume that if great companies are falling, something must be wrong with the companies themselves. But in a liquidity event, that is not always true. When funds need cash fast, they don't sell what is hardest to move. They sell what they can sell immediately. That usually means the most liquid, most widely owned, and most profitable positions. In other words, they sell the winners. That is why large tech stocks can get hit even when their businesses still look strong. They become the quickest source of cash. And once that process starts, algorithms can make it worse. Machines don't care about stories, branding, or long-term vision. They react to volatility, price movement, and risk signals. If conditions worsen, they cut exposure fast. So what begins as a few big funds raising cash can turn into a broader wave of selling. That is why strong stocks often get hit first in a real stress event, not because they deserve it, but because they are the easiest place to extract money. Then the damage moves beyond Wall Street and into the real economy. Higher yields don't just hurt traders, they hit banks, lending, and real estate. Banks hold large amounts of bonds, and many of those bonds were bought when rates were much lower. When rates rise, bond prices fall. That weakens bank balance sheets. Even if the losses are not immediately realized, the pressure is still there. And when banks feel weaker, they become more careful. They lend less, they tighten standards, they approve fewer loans. That matters because lending is what helps businesses expand, families move, and local economies function. Once that flow slows down, growth slows down with it. Then comes housing. A lot of people still think mortgage rates mainly follow whatever the Federal Reserve says in a press conference. But mortgage rates are closely tied to the 10-year Treasury. If Treasury yields move higher because bond selling intensifies, mortgage rates can rise quickly even without any dramatic new announcement from the Fed. And when mortgage rates rise fast, housing activity can freeze. Buyers can't afford the monthly payment. Sellers don't want to give up the rate they already have. Deals fall apart, volume drops, and the industries connected to housing start feeling the strain. Then there's commercial real estate, which may be even more vulnerable. Many buildings and projects were financed under the assumption that money would stay cheap. If those loans need to be refinanced at much higher rates, the numbers can stop working entirely. That is when defaults start becoming a real risk. So what begins as stress in bonds becomes stress in banks, then in borrowing, then in property, and finally in the broader economy people actually live in.
But the story gets even more dangerous when you look at the parts of the financial system most people never see. Beyond traditional banks, there's a huge world of non-bank lenders, private credit funds, hedge funds, and leveraged institutions that grew rapidly during the years of cheap money. These players often operate with fewer guardrails and less public attention. They were built for a world where borrowing stayed easy and liquidity stayed available. But when rates rise and funding gets tighter, those structures can crack fast. And unlike the traditional banking system, they do not always have the same backstops. There is no simple safety net that makes everyone calm again overnight. If one of these large players gets trapped, the losses do not disappear. They travel through pension exposure, retirement funds, credit markets, and counterparties. That is why some of the biggest threats in a financial shock do not appear on the front page at first. They sit in the corners of the system that looked safe only because money was cheap. And this is exactly why policymakers are cornered. On paper, they still have tools. In reality, every tool comes with a cost. One option is to inject liquidity, lower pressure, and calm the markets. That can buy time. It can slow panic. It can prevent a disorderly collapse, but it can also weaken the currency and bring inflation pressure back to life. The other option is to keep conditions tight, defend credibility, and refuse to rescue the system too early. That may protect the currency in the short term, but it also increases pressure on debt, banks, and growth. In other words, one path risks inflating away the value of money, and the other risks breaking something large enough to drag the economy down. That is the trap.
The people in charge are not choosing between a good outcome and a bad one. They may be choosing between two different kinds of pain. So what should you actually watch if you want to know whether the pressure is building? Start with the U.S. 10-year Treasury yield. That is one of the most important rates in the world. If it starts rising quickly, it is often a sign that stress is spreading through the bond market. Next, watch the dollar against the yen. If the yen strengthens sharply, it can be a sign that the carry trade is unwinding faster and that forced repositioning may be accelerating. Then look at volatility. If the fear gauge suddenly wakes up after a quiet period, that is usually not random noise. It often means the market is starting to price in a rougher environment ahead. Credit spreads matter too. If risky borrowers suddenly have to pay much more than safer borrowers, the market is signaling that default risk is rising. And finally, pay attention to bond market behavior itself. If prices start gapping, swinging strangely, or moving in ways that feel disorderly, that can mean liquidity is thinning out. These are not just abstract financial indicators. They are the tremors that often show up before the main quake. Now let's talk about protection, because fear without a plan is useless. In an environment like this, the goal is not to predict every twist perfectly. The goal is to stay durable. That starts with liquidity. When markets are forced to sell, liquidity becomes valuable because it gives you time, flexibility, and choice. It keeps you from being cornered. It allows you to respond instead of react. It also means being more careful around fragile parts of the market. Hype tends to suffer when money gets tight. So does heavy leverage. So do speculative names that only looked strong when borrowing was cheap and investors were chasing risk. This is where quality starts to matter more than excitement. Balance sheets matter more. Cash flow matters more. Business durability matters more. Some investors also shift attention toward more defensive areas, the kinds of businesses people still rely on even when the economy gets shaky. And it is also important to understand the difference between short-term safety and long-term protection. Cash can help during a liquidation phase because it preserves flexibility. But over a longer period, if policymakers respond with looser money and a weaker currency, inflation becomes its own threat. That is why protecting money is not about one magic asset. It's about building resilience against both market instability and currency instability. You do not need a perfect crystal ball. You need a setup that can survive being wrong for a while. And when you step back, this becomes bigger than one market, one country, or one ugly trading week. Japan matters because it's been tied into the plumbing of global finance for years. If that pressure becomes something larger, the shock will not stay neatly contained. It will move through money flows, debt markets, banks, housing, and eventually daily life. That is why ignoring this story is risky, not because every worst-case scenario happens tomorrow, but because most people wait until the damage is visible before they start paying attention, and by then the good options are usually gone. The real danger is not seeing the crisis after it hits. The real danger is missing the signals while there is still time to prepare. In the next part, we're going to get even more practical and walk through the specific mistakes that leave people exposed and the step-by-step checklist you can use to reduce risk before this gets worse.